Okay. So in chapter 10, we were dealing with issuing stock, selling stock. And so now in chapter 11, we're dealing with dividends. So basically, stockholders may have stock that pays dividends, whether it's preferred or common. And that's part of the company's way of increasing the demand and maintaining the demand for their stock. They have a good stock that pays good dividends, then more people wanting to buy it, the price can go up. It promotes growth of the stock. And so if they can, companies like to reward their owners or their shareholders with dividends. So the board of directors is the one that will usually decide to declare a dividend. And then you will have preferred versus common stock. If you remember, preferred it doesn't have voting rights, but it has first dibs at the dividends. We'll have 3 different dates going on. The date of declaration, which is the date that the board declares the dividend. At that point, it becomes a liability for us. Okay, and so we'll record that as dividend payable. And I'll have a future date that we want to, the date of record, which is basically on that date of record, we're going to use the numbers, the stock price for that day to pay the dividends. So that's the date of record. But then once you decide on that date, it's going to take time to actually cut the checks and get all the paperwork done. So the pay date is usually after the date of record. Okay? So they declare it, and then on a certain date, that's the date that they use those numbers to calculate. And then we'll pay it after that, just because it takes time to write the checks and that kind of thing. Okay? So first thing we're going to do is look at the calculations for declaring what we declare the dividend, and then how much is going to go for the preferred stock versus the common stock. Okay, so calculating the dividend is what we're going to look at first. So actually on the back side of your first page of 11.1 working together, it gives you some space to kind of figure this out. One thing I want you to remember, we'll just make a little note up here, that dividends reduce owner's equity, which for us is basically retained earnings. Okay, so if you look at the T, and actually dividends act like the drawing account. If you remember way back to the beginning, you have owner's equity, and then anything the owner pulled out, we use the drawing account for. Well, that's what dividends are. It's money being pulled out of the retained earnings or the owner's capital being paid to the owners. Okay, so it's going to reduce owner's equity. Okay, and then the next thing I need you to remember is that when a dividend is declared, so when the board of directors declares the dividend, it becomes a payable for us, a liability. Well, let's put payable. It becomes a payable because now we owe it to our shareholders. Okay? So when we look at the working together for 11.1, it gives us information up here about our shares. We have 8,000 shares of 6%, 100 par value preferred stock, and 50,000 shares of $1 par value common stock. Okay, so we'll need some of those numbers. And then on April 1st, the board of directors declared a quarterly, pay attention to that word, cash dividend of $25,000 payable on April 30th. Okay, so then you can see on April 30th, we're paying it. Okay, so that's the first transaction we're going to figure out. Now to do that, remember our preferred stock is taken care of first. So we have $8,000 of 100 par value stock. So 8,000 times 100, and we'll write all this out in just a second, is 800,000. And then the 6% is the amount of dividend that you're going to get. That's why you bought that stock, because it's got a 6% dividend. Okay, so we'll figure out the total value of the stock, figure out what 6% of it is, but remember quarterly, so we only need a fourth of that. That's for the whole year. That 6% is for the whole year, so we'll have to divide by 4 for that. And then that'll figure out what the preferred stock dividend is. And then they said it's $25,000. So whatever's left after the preferred stock holders get paid, the rest of it will go to common stock. Okay? All right, so that's what we're doing for the April 1st transaction. All right, so this is when we declared the April 1st cash dividend. Okay, so number of shares, we have 8,000. Let's do this. This is preferred. Okay, 8,000 times par value, which is $100, equals 800,000. Whoops, let me put that in here. Okay, and so this is the par value of preferred stock. All right, now 6% of that, it's a 6% stock. So 800,000 times, and you could do this two different ways. You could do 6% divided by 4 to get the quarterly, or you could figure it out and then divide the total by 4, which is what I actually did first. But I think the book shows you this way. Okay, so 800,000, well, let's do 6 divided by 4 is 1.5%. Okay, so if we did 800,000 times 1.5%, gives us $12,000. Okay, so this is the value of the par, this is the percentage, and remember this is because it's quarterly, and they told us that in the book. If they just were doing the dividends for the whole year, you wouldn't have to do the divide by 4. So just watch the instructions to see what it is you're doing. Okay, so this is the amount for the dividend for preferred. Okay, $12,000. Now, it also tells us in the book that the board said 25,000. So 12 of it's going to preferred, and the other 13 is going to go to common. Okay, so basically we take the 25,000, which is the total dividends, minus the 12,000 for preferred, equals what's left for common, which is 13,000. So you may be thinking, well, that's more than the preferred, but there's only 8,000 shares of preferred paying $12,000, and there's 50,000 shares of common. So this, you're going to get, I don't know, a little over $1 here for preferred per share. So if you own 100 shares, you're going to get 100 times whatever that amount is. But for common stock, there's 50,000 shares, so you're going to get a couple of cents. Okay. Okay, so this is the, let me write it over here like this, dividend for common stock. Okay. All right, so now we need to get these numbers into, so there's the total, and then there's those two, into our general journal, because we're not paying it right now, so it's not cash payments, we're just declaring it. So on April 1st, we're declaring a dividend. Remember, we have dividends, which, let me write that down, look like this. Okay, and then of course a payable, every payable has a normal balance of a credit anyway, so that's what we're using. And we're going to split it up into common and preferred. So we just have one entry for the two different stocks. So dividends common, and that is our 13,000. And then dividends preferred is our 12,000. And then dividends payable is our 25,000. Okay, and it says this is memo 32. Okay, so this is declare. So it looks like when we declare the dividend. And then it says on April 30th, we're paying the April 1st dividend. Okay, so we're actually paying it, so it's going to come down here to cash payments, and this is on April 30th. We're paying our payable, so that's going to be our debit. And this is check number 533. And of course the cash credit, 25,000. Okay, so this is to pay the dividend. All right, declare it, pay it. Okay, then the next thing that we're doing is declaring a stock dividend. So this is actually a cash dividend, declaring a cash dividend. But then in your book it talks about maybe the business doesn't have a lot of cash, but they feel like they need to give something to their stockholders. They need to try to maintain or promote growth of their stock price. And so what they're going to do is they're going to issue more stock. I mean, they've decided, when they first decided to go public or, issue their stocks, they may have decided that there's a total of 1 million stocks, but they've only issued so many. They don't necessarily issue every bit of stock from the very beginning. They hold on to it because then as you need money later on, then you can start selling chunks of that. Okay? So now at this point, we want to basically use stocks to help our stockholders. So they're not going to get cash, they're going to get extra stocks. Okay? So now we're declaring a stock dividend, and are working together. Let me get back to it. says that an economic downturn made it impossible for Western Tours to declare its regular quarterly cash dividend. In lieu of cash dividend, the board of directors declared a 5% stock dividend on common stock. The market price of the common stock on July 1 was $6.90. Okay? Now, they're not including preferred in that because, like the preferred, they can hold on to that and pay it later. They'll keep track of it and then pay the full dividend later. They don't have to pay it this quarter. But they still feel like they needed to do something for the common stock. All right. So back to this side. Okay, again, this was declaring the July 1st stock dividend. And it said that we're going to declare a 5% stock dividend. So it tells us at the top we have 50,000 shares of $1 par value. Okay, so 50,000 So number of shares, 50,000 shares times 5%, which is the dividend percent, equals 2,500. Okay, so that's the number of shares that we're going to issue. Okay, and they're only worth $1 a piece, right? Par value. So kind of remember that, 2,500. All right, but it does say that the market value is $6.90. So that's the actual amount that we're giving them. Okay, so we're going to take the 2,500 shares times the $6.90, because this is the market value, and again, number of shares to be issued. Okay, the market value. And so 2,500 times $6.90, 17,250. Okay, so that's the actual amount of the dividend, the dollar amount of the dividend that we're giving when we're giving $2,500 shares. Okay, so this is the stock dividend amount. Okay, so we'll take these numbers, come back over here, and this is all happening on July 1st. All right, and like I said, right here, our stock dividends are 17,250. So this is going to be stock dividends. This is understood that that's cash. This is stock dividend. Okay, it also says this is memo 57 for 17,250. Okay. Now the stock, got two accounts we're looking at here. Stock dividends, distributable. It's a mouthful. Distributable. Okay, so basically this is the amount of the par value. Okay, so that's 2,500. Because it's not payable, right? It's distributable because we're distributing, we're not paying it. But there's a difference between the dollar value of the stock at par value versus the market value. So that difference is a paid in capital in excess of par value. And actually they use the word common too, but I don't know if I can get it on there. Par value common. Okay, and so just the difference between those two is that paid in excess. Okay, and again, this is declaring. Okay, so again, stock dividends distributable is just like dividends payable. Okay, this was all done at par value. Okay, so we didn't have any paid in excess. So we don't have that extra line, all right, but we do here. Okay, and then it says that you issued it. You basically paid in stock, okay, on the 31st. So July 31st. Again, it's just like this. Dividends payable. This is our equivalent of dividends payable. So we're reducing that. Stock, dividends, distributable. Okay, and this is memo 68. And this is just the 2,500. Because to us, that's what that stock is worth. $1 a piece. Okay, the market value, yeah, we're going to give it credit for the market value. That's the paid in excess part. But the amount of stock that we're distributing is from our par value. Okay, and capital stock common. Okay, so now we've got more of this capital stock out on the market. Okay, so it says issue or kind of paid. I think I've seen some of the instructions that say pay the stock, even though you're not paying cash, right? You're paying with the stock. Okay, and this is basically issuing more stock out there. All right, so there's 11.1.